having a seller understand kind of where the market is today is really helpful, right? If you have a seller who has only sold buyout historically, where the discounts are quite small, the market venture discount will look very, very deep. And so making sure sellers have an understanding of where the venture market's trading today, and then maybe how their portfolio might differ with the general venture market would be very helpful.
Hi, everyone. Thank you for tuning in to another episode of Women of Secondaries, produced by SecondaryLink and hosted by yours truly. My name is Kristina Kulikova. I'm the VP of LP Advisory at Setter Capital, and I'm absolutely privileged to host Women of Secondaries, where we cast light on the incredible powerhouse women driving this market. If you missed our prior episodes, make sure to check out Christine Robinson, Director at PJT Partners, and Terry Buffery, former Principal of Morningside Capital Management, on the SecondaryLink website's video and podcast section, or catch short snippets of it on the SecondaryLink LinkedIn page. On this episode, I'm chatting with one of the most active players in the venture capital side of the secondary market, and a regular buy-side firm I personally have had the pleasure of working with over the last 11 years, Industry Ventures. Headquartered in San Francisco and with offices in London and Washington, D.C., Industry Ventures has cultivated new segments of the venture capital market for over 2 decades. They manage over $7 billion of institutional capital and support founders, general partners, and institutions across the private tech ecosystem. Their funds invest into companies and venture capital partnerships directly and via secondary transactions. Today, I am excited to welcome an incredibly dedicated woman with extensive background in the software and tech verticals, a professional with over 10 years experience at the firm, and now principal at the firm Industry Ventures on the secondary funds team. Welcome, Justine Huang. Hi, Justine.
Hi, Kristina. Thanks for having me.
No, we're super thrilled to have you on board. And I think before we jump into the main part of our chat, I would love for our audience to get to know you a little and perhaps delve into how you transitioned from some of your research equity work while at Goldman Sachs, I think, and then ended up in secondaries.
Yeah, so to be quite frank, I kind of fell into it. So I worked at Goldman Sachs in their typical kind of summer analyst program on the public research side, focused on software and internet, and really enjoyed that work, but realized that there was a lot of action happening in the private markets. This was kind of 2014-ish timeframe, when you had companies like Uber and Airbnb and all those names were private and quite active on the private side. And so I realized that I wanted to get some exposure to that part of the market. And so coincidentally, so I was a senior in college, I found an internship posting at Industry Ventures and interviewed with Ira Simkovich, who's now one of our managing directors, when he was a senior associate. And so, I went back to Goldman Sachs full-time on the public equities research side and learned a ton there. I think, you get exposure to some mega cap companies very early and you get to meet management teams and investment managers who are all very accomplished, but I still had an itching to go back to the private side of the markets. And so had the opportunity to rejoin Industry Ventures as an associate and have been there for quite some time ever since. I also spent some time in between kind of working with actual portfolio companies. So I went to business school at Wharton and spent some time with Curology, which is a portfolio company of some of the funds that we've backed at Industry Ventures in strategy and operations, and worked on a few other projects, which was a great experience, but really enjoyed my time here. And so decided to rejoin about 4 years ago.
Yeah, it looks like industry has really been a continued part of your career path right throughout. And so what would you say? You clearly love it there. What is the favorite part of your job?
I'd say there's 2 parts. There's the internal part where we have a fantastic team, right? I think that's one of the number one reasons why I rejoined the firm and have been here for so long. I work with an incredibly dedicated group of folks who are very, very sharp, and we always kind of push ourselves to be better. So that's certainly one part of it. And then in terms of VC secondaries, I love our ability to meet with GPs who are investing on the cutting edge of technology and be able to sit in a room with them and talk through their portfolio and understand kind of their view of the world. And on the flip side, we do a number of direct deals as well. And so being able to meet these entrepreneurs who are driving kind of the new technology trends is very exciting.
That's amazing. And I think there's always, you like it at the firm and obviously the team and the founders, but I gotta say there's always the flip side of the coin. Perhaps during the deal execution process, are there any parts of the job that you just, kind of like a pet peeve or something that you don't enjoy quite as much?
Yeah, I mean, look, the reality is we have an amazing ops, finance, and legal function now, kind of headed up by Aaron Hines, our CFO, and Valerie Lau, our general counsel, who have helped streamline the parts that I don't necessarily love, which is kind of the closing process, right? With all the legal docs flying back and forth. All of that's in good hands with Valerie now. So I think my least favorite part is now no longer necessarily my entirely my domain. Yeah.
It's interesting. I have a fellow guest in the future episodes who is a lawyer and heading up secondaries for one of the firms, and I'll be interested to get her take on the parts of the deals that everybody else doesn't quite enjoy as much.
Yeah, no, that'll be very interesting.
But as you think back through your career path, and is there any specific person or somebody that's kind of been your biggest influence in the industry today?
Yeah, so one of our partners, Lindsay Sharma, has been a mentor of mine since I was an associate. So she started off on the secondaries team at Industry, and now she heads up our tech buyout strategy. And on a Women of Secondaries podcast, I think you can relate to the fact that it's always really nice when you get to work with powerhouse women in the industry. And so she's kind of shown me, a lot of help in my career in terms of both personal and balancing kind of work and personal life. And she's been a fantastic mentor and is now doing great work heading up one of our newest strategies.
And what would you do if you weren't at industry, or maybe broader, if you weren't even in finance? Is there a particular passion or something you would do outside of finance?
I love to cook, and so I would love to spend more time in the food realm, right? So I don't think I'm talented enough to become a chef, but working in that world might be something of interest. But yeah, I really enjoy my job, so it's kind of hard to imagine.
Can I adopt you into my family? Because nobody in our family likes to cook.
Sometimes it's hard to balance, all we do day in and day out in cooking. So I will say I kind of put cooking into two buckets, right? Food to feed yourself to make sure you eat, and then, fun recipes and things to do and over the weekend or in spare time. So yeah, sometimes I also don't like to cook, to be fair.
It's tedious, right, when you're exhausted from work. But thanks for playing along with the rapid fire sort of question section. And, I'd love to get into the main part of our chat today, of course, and get your expert views on, I would say, the sometimes volatile, confusing, difficult to predict and underwrite, yet very innovative world of VC secondaries. And I have to say, from a pricing perspective, I mean, I've personally seen the highest swings and the highest volatility in pricing when it comes to VC funds. And even in the bids we see, it can swing anywhere between 20 to 30% differences between the bids in some cases, right? And I think just recently announced Lexington bought a $1 billion portfolio of VC funds from Horsley Bridge, and apparently at like a 40 to 50% discount. I think also the PJT report and the SecondaryLink data for Q1 shows that pricing is kind of, 30, 35% discount in Q1, perhaps more. Being in your seat, what are you seeing in the market, and how does pricing differ perhaps across verticals?
Yeah, absolutely. And I want to caveat this all with this is not investment advice. This is largely my opinion. So we focus on venture and growth at our firm. And so that's kind of the lens that we're coming from. The discounts are quite wide. So we've been doing this for over 20 years, like you mentioned. We're in something like 600 plus funds. And so we can see a lot of data points across our portfolio. And an underlying portfolio company might be marked one way in one fund. And, there might be a 50% swing up or down in the marks of another fund on the same company. And so that translates to a wide dispersion of pricing when it comes to those funds, right? If you just think about, if they're concentrated in that name, then if you're valuing asset A at 100 in one fund and 150 in the other fund, but we all fundamentally believe that the price of that asset is, call it 125, then the pricing for those two funds will be very different. And so we're seeing that quite a bit. I don't want to make massive generalizations, but I think broadly speaking, you have firms that have very strong valuation teams who are doing quarterly valuations based on comps, based on the actual performance of the company, and their marks move every quarter. And then you have some smaller funds that might not have the same infrastructure who typically revalue assets at the end of each year. And so the smaller funds sometimes might not have the same information, just might not have the capacity to do the same work that some of the funds with the larger valuations teams have. So sometimes the valuations are more stale in some of these funds versus some of the funds that are marking to market each quarter. So that sometimes translates to, again, dispersion in pricing, even though the assets might be similar.
And would you say that, I guess, in line with that, it's more related to the pricing variability you see more across GPs or more across the verticals, or both?
Yeah, I would say it's both. Enterprise SaaS is probably the bulk of what you're seeing show up in the data that you see via PGT and some of the banking data, just because that's the largest part of the VC ecosystem today. So I would say that, there are some, early stage deep tech has a ton of dispersion, right? So sometimes, unless they're concentrated in a name that's very well known to the market or a name that's kind of farther down the road that has kind of less binary outcomes, typically maybe that would price a little bit deeper versus, some of the later stage software based funds where, it's a lot of recurring revenue, kind of how this type of company would trade if it goes public. Maybe it's a company that's on the precipice of going public. So I'd say the pricing range for the latter type might be tighter and typically is closer to what I would call market. Versus, something earlier stage, maybe riskier, might have a deeper discount to kind of compensate you for that type of risk.
Yeah, and when it comes to capitalization, I think of secondaries in general, I think it was the PitchBook Q4 private markets fundraising report that noted that VC secondary funds had their second best fundraising year in 2023. I think it was around like 3 billion raised in total, just below the peak of 3.1 billion in 2022. And obviously, this growing capitalization will likely continue to drive volume. What are the biggest sectors where you expect to see the highest amount of secondary deal volume in maybe both VC funds, co-investments this year?
Yeah, I think one trend we're starting to see more and more of is GP-leds in the VC secondaries market. There have been a few articles around different GPs kind of thinking through that process that have been kind of leaked to the press, but I would say we're seeing more and more volume on that front. And when you think of how GP-leds have influenced the buyout secondary market, I think it's become quite a large percentage of their total deal volume. I think we'll start to see that movement in the venture secondaries market. So I would say that's probably the biggest change we've seen in the last kind of 6 to 9 months.
Yeah, and I think it's probably on the growth trajectory to just continue and perhaps exceed that of LP transactions.
I mean, so long as the IPO markets are kind of like they are right now, right? We're seeing some green shoots, but we certainly are hearing anecdotally more and more companies are still looking more towards 25 and 26 to list. You have these funds that are coming up against 10, 12, 14-year kind of lifespans. And so a lot of those GPs are a little itchy and they know even if a company goes out latter half of 25, depending on if the manager's on the board or not, right, it's going to take them a while to trade out of that and get that liquidity. So we're seeing a little bit of antsiness both at the LP and GP level that I think is also kind of driving that trend.
Yeah, not to mention probably competition for capital once it hits 2025, 2026, once, the market kind of more opens up.
Yeah, exactly.
Yeah. And are there any, you mentioned more strategy specific, but are there any geographic markets that you expect to see the strongest VC secondary returns from, maybe outside of North America and Western Europe?
Yeah, I'll caveat it again with, returns are still TBD, but I think we're seeing more action in both India and in LATAM. I think in India, you're seeing, the stock market perform really strongly. You've had a few IPOs and exits from venture-backed companies. And so I think that started a bit of the flywheel over there. And so we're seeing some more interesting deal flow from that part of the world. And then LATAM has always been an interesting geography for us as a firm. We've backed some amazing managers there. We've gotten some really good liquidity out of Nubank and some of the other names that have gone public out of LATAM. And we think we'll continue to see interesting portfolio companies there and deals at interesting valuations.
That's exciting. Yeah, no, thanks for elaborating on that because there's so much talk around kind of the core markets, but it's nice to see some of the other, I don't want to necessarily call them emerging markets, but, come to fruition. Um, and this is an interesting component, or I think a trend, but not so much a trend anymore, but a rise in direct VC secondaries. Whether it's been, Temasek and Fidelity's discussion around the secondary and lens card, or more broader auctions of kind of the large unicorns or decacorns like Wiz or Rippling. Has the rise of the direct VC secondary market impacted your underwriting for companies? Like, has it helped with intel or visibility or anything like that?
To be frank, we've been doing direct secondaries basically since inception. And so for us, it's always been a part of our business and part of our portfolio. And so I would say for us, I think there are more deals being done in that part of the market, but I wouldn't say it necessarily has impacted us directly just because we're active on both sides of the market and have been for a very long time.
Got it. And have kind of deep expertise in the underwriting, obviously, across the sectors, right?
Yeah, we spend a lot of time understanding what's going on in the VC secondary direct market as well as the LP side of things. And so we can kind of leverage kind of everything we see across all the deal types.
Are there any confirmations for when you hear a transaction being done, a specific valuation on the direct side? Does that help any of your fund deals?
Yeah, sometimes it does, right? Sometimes we can say, all right, we're pricing this here and it's in line with where we know direct secondaries are trading. And so it is a fair value that you can go to an LP or GP with.
Yeah, because I think that probably that part of the market has been so non-visible, right, or lacking transparency for a long time outside of experts such as yourself, that I'm finding that there's a lot, maybe perhaps deeper understanding now when you're talking to either LPs or GPs even of saying, hey, this is where this direct deal traded, and it's kind of helping to establish a deeper understanding of why there's certain discounts in the markets for certain companies.
Yeah, and I think that's right, but I would say that a lot of that knowledge and data tends to be concentrated in the decacore names that you were alluding to, right? Because there's more volume in those names. And so I'd say the same kind of opacity still exists to some extent in the earlier stage part of the market, right? Where there might be some trades that you can see on like a Cap Light or a NASDAQ private markets or something like that, but it's, one employee who traded a small percentage of ownership, right? Or we're talking like sub a million, that, it is a data point, but it's not the only thing that's informing pricing.
Yeah, and it's not an institutional data point per se, right, at that point.
Exactly.
And what about for companies in line with that, as you guys do a lot of deep company due diligence, how do you underwrite companies with sort of little operating history? Do you have a go-to sort of source for diligence, or how do you deal with those situations?
Yeah, so like I mentioned previously, we have relationships with hundreds of venture funds, and we actually do back a decent number of emerging managers focused on the early stage part of the market. And so they have exposure and a viewpoint on a lot of companies within that ecosystem. So we're able to tap the expertise of the GPs that we backed. We think they're fantastic, and they've shown an ability to kind of figure out who can be the winners at a pretty early stage. And so we do chat a lot with those folks because they're trusted relationships with the firm, and they're really tapped into that market, right? I think it's pretty hard to be very tapped into the pre-seed part of the market focused on specific sub-vertical, but those are the GPs that we back. And so we're able to work with them to help us underwrite some of those companies when we see them in portfolios.
That sounds like a crucial relationship to have, being in your seat, for sure. Now, this is a question we get asked all the time being on the advisory side, especially for tail end deals. What would you tell a seller of maybe tail end venture funds is sort of the delta of holding on to their older funds versus selling? And how do you underwrite value specifically in a tail end kind of VC fund?
Yeah, and this is actually quite a tricky part of the market, and I know there are certain firms that really focus on this. I'd say there's a few different kinds of tail end VC funds, right? We see some tail end funds that are still around because they're in companies like SpaceX, right? That have been around for a while, but just haven't gone public. And so those funds to some extent are easier to underwrite, right? Because you have a point of view on SpaceX, and typically that's the vast majority of the NAV that's left. Where it gets trickier is some of these older funds that have lesser known companies. Maybe they're diversified across, 3 companies that are left that might still be kicking around and don't have a clear exit path, but are certainly viable companies on their own. And so it's not clear what impetus there is for the fund to wrap up. And so, I think if you're a seller of tail end funds, you probably know which kind of tail end fund you have, but that is a huge consideration. And I think, one of them, you do the company work to see if you think you're going to get natural liquidity at the company level, and then compare that to what you can get on the secondary market today. But usually those price better in the secondary market versus the more diversified, unclear kind of bucket. I think a huge consideration from our standpoint, if I was a seller, is the IRR, right? Like how driven is a GP or a management team of those underlying companies to maybe sell to a strategic or sell to a buyout fund or just buy back the shares themselves. That is a huge question. And I think, evaluating what's in there is certainly part of it, right? Is it healthcare maybe where, there's some strategic interest, or is it maybe a basket of software companies where we're seeing an increasing active kind of tech buyout market that's interested in these smaller companies, maybe as add-ons to platform plays or standalone for these smaller cap buyout funds. I think it really depends on what's kind of underneath the hood, so to speak.
Yeah, and I think, a lot of, to your point about there's a lot of specialist buyers who focus on the tail end of the market, but I find perhaps it's easier on the buyout side than on the venture side, because a lot of groups will buy them to kind of boost their own funds DPI, right, with kind of earlier distributions. Not so much on the venture side. I think that would be probably a more difficult argument to make.
Yeah, I would say probably more difficult than buying a tail end buyout basket, right? I think some of those tail end buyout assets can pay out dividends, right? And so you're getting cash flows from those portfolios in a way that a lot of the tail end VC funds are not necessarily getting dividends or generating cash flows in the same way. So it's certainly a little more difficult than the buyout side of things from that standpoint in generating DPI.
No, that's helpful. And is there, in speaking about more kind of on the LP side as well, what is a suggestion you would give a seller before they decide to sell some of their VC funds? Are there any factors that they should be considering or expecting in general before they decide to launch a process?
I think it depends on what the LP's goals are, right? Is it just pare down your VC exposure? Is it pare down the number of manager relationships? Is it to reallocate to new managers? I think just trying to really think through the motivations are really key in how you want to approach this kind of process. I think, to be frank, in the current market, having a seller understand kind of where the market is today is really helpful, right? If you have a seller who has only sold buyout historically, where the discounts are quite small, the market venture discount will look very, very deep. And so making sure sellers have an understanding of where the venture market's trading today, and then maybe how their portfolio might differ with the general venture market would be very helpful. The other thing I would note is venture funds, certain venture funds can be somewhat restrictive on who can transfer into their funds. And so having sellers understand the dynamics of certain GPs will only let an LP sell to existings. Certain GPs don't like to have secondaries, they'll buy things back themselves. I think just understanding the GP's viewpoint on secondaries is also quite helpful, because secondaries are newer to the VC ecosystem. Some VC GPs, especially the newer ones, haven't ever done an LP secondary, right? So there's some education that goes along with that versus some of the established VC multi-stage funds. They have an entire team that processes secondaries every quarter. So I think there's probably more idiosyncratic details to work through in a VC portfolio than maybe some of the other kind of verticals within the secondary market.
Yeah, that's perfect. The fact that it might play into taking a little bit longer sometimes to transfer as well, if they're just not used to having a transfer process in place, or it is a restrictive GP. All right, well, this is the part that we can perhaps chat a little bit more about performance of a deal. What components does a hypothetical deal need to have to make for a good secondary venture deal, both maybe at the fund and at the co-invest level, and sort of meet and exceed industry ventures targets?
Yeah, absolutely. So I think one of the themes that we've been focused on over the last few years is a flight to quality in the venture ecosystem. So what we like to see is talking about fund secondaries and GP LEDs, we like to see a deal where the fund or the portfolio is anchored in at least one, if not, two or three really strong assets that are considered high quality venture assets. For us, we've been spending a lot of time in kind of the mid to late stage parts of the market, right? Companies where we think we can get liquidity in 2 to 4 years, either because they're really strategic, so by M&A, or by IPO. And so that's what we like to see within the more kind of multi-asset deals. I would say we are looking for also kind of incentive alignment, right? I think that's always a question within the secondary market. Sometimes within the direct VC secondary market, it can be particularly acute, right? You have people selling off the cap table, so you have to, there's some level of needing to understand kind of the motivations behind that. So I would say there are a lot of things that have to align for a deal to get through our process and exceed our expectations. But I'd say quality of underlying portfolio companies is first and foremost, and then having the right dynamic with the sellers and the process at hand is quite important.
Yeah, and I think that this next question might be a little bit tricky to answer, and feel free not to go into as much detail perhaps, but are there any thoughts you can share around performance of secondary VC fund deals compared to primary VC fund deals in the recent past? Any noticeable differences from kind of pre-COVID period till now, or more generally?
Yeah, I think in the COVID period and post-COVID, it kind of remains to be seen, right? To be frank, I think there's a lot of paper market flying around, but there haven't been a lot of exits in the venture ecosystem. So we're still waiting to see what the ultimate, actual DPI of both primary and secondary funds are that were invested in the last kind of few years. I would say broadly speaking, look, we're seeing some of the primary VC funds start to buy direct secondaries, particularly in the companies that they're already invested in, because either they have deep conviction and want to continue buying up ownership, or they're trying to blend down price because venture pricing was so steep in 2021 and early 2022, right? And so there's a little bit of convergence of like what truly constitutes a primary VC fund, right, versus maybe just a direct secondary VC fund. And so it's a little tricky to answer from that standpoint. I would say if you look at the Cambridge benchmarks over the last, call it 10 to 15 years, I have a feeling, and again, this is a conjecture of mine, that a VC secondary fund likely has pretty decent IRR and pretty high DPI relative to its primary venture counterparts. But the primary venture funds ultimately sometimes shake out with higher kind of TVPI, right? With maybe a similar or lower IRR, depending on kind of the stage of the venture fund. So I know it's a lot of generalizations, but that's what I think we'll start to see more of, and we're still on the lookout to see what happens in kind of the post-COVID era.
Got it. Well, thanks for answering that in the first place. And I prefaced it that, no sort of full research report here. I didn't expect that. So thank you for opining on that. And just for sharing your expertise. And I think last but not least, I'd love to, given that this is a Women of Secondaries podcast, I'd love to get your perspective on what do you think is the strength that women bring to secondaries and especially deal execution?
It's an interesting question. I would say, especially in the venture secondaries world, right, having a deep network is incredibly important. And I think for better or for worse, there's a very strong network of women in the venture ecosystem explicitly within secondaries. And so that brings a diverse new viewpoint to our investment committee to some extent, right? So I know a lot of really awesome female GPs in the venture ecosystem who have a point of view on companies that might be slightly different than some of the male GPs that are on the same deal. And then it also brings a unique kind of vantage point for sourcing and getting to know GPs and companies in the ecosystem. So I think, it's not just for women within the secondaries market. I think, having different opinions around the table and different networks around the table is always very helpful. At least for our firm, we've seen it kind of work for us, and I'm sure it's the same in a lot of other firms.
I love that answer. You're encouraging a lot more women to plug into this industry. So. Well, thank you for joining us on the show today, Justine. And we've worked on a number of transactions over the years. We've chatted about them, and it was so nice to sit down with you and kind of really dig into the depth of your expertise in this market, and which obviously continues to grow with astonishing speed. And I really want to thank you for coming on board and sharing your insights and kind of really shedding some light into the sometimes closed book of VC secondaries.
Yeah, thank you for having me on. Really enjoyed the conversation.
That's awesome. And once again, this has been Justine Huang, Principal at Industry Ventures Secondary Funds team. Thank you for joining us, Justine.
Christina.
And as always, watch the SecondaryLink LinkedIn page for updates on our next special guests, and we hope to see you in a few weeks where we highlight the next incredible woman on Women of Secondaries.